We'll just start the presentation with just giving a very brief definition of business financing. And it's really the capital that people require, whether to start up or to develop, maintain, expand their current business operation. That's probably the most simple definition that we can come up with. While it is a necessary component of any business operation, that is the financing requirements, it is not sufficient to achieve the business success. The other critical factors of production, particularly fixed assets, labor, and entrepreneurial capacity, that is the management, must be efficiently combined with capital for the success to be realized. In terms of financing options, there are several options that are available to entrepreneurs. The most common one that is used in St. Vincent is really to come to a bank to borrow money. The type of funding that banks provide, we can do long-term loans, whether it's for fixed capital acquisition, and we have short-term lending by way of overdraft or other short-term instruments for working capital support and to cover operational expenses. These are things that most business people are familiar with. Other financing instruments which are not very popular in St. Vincent in terms of business folks actually looking to get these kinds of options. Bond financing, that is, you can arrange as a private sector individual rather than coming to a bank. You can arrange for a bank or an investment house or perhaps even an accounting firm to put together a package for you to raise a bond. A bond is really debt financing. It's where you can create an instrument. You still have to sell it. You do a prospectus, you sell it, you get the persons who are actually going to acquire that bond to believe in whatever you are doing in your business so that they can, basically a bond holder is somebody that is basically replacing a bank. We can do a commercial paper, again, a finance house or a bank can raise that for you. Again, it's something that's on your business and we just do a paper and people subscribe to it. We have other things like letters of credits, which are used mostly for trade financing, collection bills, customs bonds, bank guarantees. These are things that, as the airlift out of St. Vincent that is expected to come naturally with the development of the airport, as that airlift increases, you are going to see not just imports coming in, but hopefully we are going to see over time Vincentian businesses exporting a lot of things overseas. And these kinds of trade financing, letters of credit, for example, your existing suppliers that you have overseas, they now have the comfort, in many cases, of asking you to set up a letter of credit which guarantees them payment on the other side before they ship their stuff to you. And they can ship it knowing fully well that the bank that has underwritten that letter of credit is going to settle whether you pay the bank or not. Now you, on the other side here in St. Vincent as an exporter, can benefit from something like that, where you can get your local bank to set up a letter of credit arrangement with a foreign bank so that you can also send your things overseas, knowing fully well that if your customer on the other side don't pay, that you have guarantee that you will receive your payments. It's just that right now, because we import more, we have more of those things going the other way, that is going out. We can in fact have them coming in as well as we improve the export activities in the country. Other financing option, equity financing, which we do right now, but we do it mostly as individuals. But before I get into the individual part of it, equity financing sometimes it's provided by development banks that we may want to fund a startup project But what they will do is probably just hold equity in it, not for forever, but they will hold it for a period of time, especially in the incubation period of a business. You have venture capitalists, that's people with money who will fund good ideas, but I mean, it's very expensive. And you have other private equity financiers, which brings me to the point in St. Vincent in particular, what we do not see a lot of are private individuals coming together and pooling resources and doing business. We have a lot of people, and we see it from the bank all the time. If you look at your portfolio of loans, you see a number of people, each of whom, if you can just bring them together, can improve their own businesses. And sometimes you try to get people to do these things, but it's a sort of cultural shift that we have to make, so it will take some time. But as we move into the next level of business and the next level of competition, we're going to find that these are the things that we have to do. On that front as well, we also have the option of equity financing via basically just doing an IPO, which is an initial public offering that is getting your company listed on a stock exchange. In that case, what you're basically doing is inviting private individuals or other firms to participate in providing financing for your company. It's just that they will own part of it, and in cases like that, when you have your AGM, which you must do mandatorily, they may come to the AGM and flex some muscles, but that's fine, providing there is transparency and there is good governance. You should be in a position to answer whatever questions are raised at an AGM. In fact, what we find is we have the ECSC, the Eastern Caribbean Securities Exchange, that has been established now for well over 10 years. And we've not seen a lot of listings in it, simply because, again, culturally in the Caribbean, especially in the OECS, we have a lot of family-owned businesses, and you find that those just continue in the family. The other thing with it too, and I think this is probably the more important one, impediment, is the fact that there are requirements for you to produce mandatorily financial statements on a very timely basis, because the market can only remain efficient if it is transparent. And you find sometimes that business people are not prepared to do those things. But in 20 years' time from now, it's going to happen. And so we're better off today. It's better that we start to explore these kinds of ideas and opportunities. Because, I mean, again, from a banker's perspective, the businesses that are successful, not to say that they are not businesses that are run by individuals that are not successful. We have a number of successful businesses in St. Vincent that are run by individuals. But the general view is that businesses have a stronger chance of being successful if different ideas, diverse ideas are brought to bear on the discussion and the process of strategic planning and visioning within that company. Just a final note on the idea of financing is that I spoke earlier of the issue of debt financing and equity financing, and I think we've explored some of the instruments that have to do it. One of the things that must be taken account of is that we must, in any business, determine the optimal mix of debt and equity financing. If a business is too highly leveraged, that is, if it has too much debt, it could become inefficient and unprofitable. If it is poorly leveraged, it could affect the growth, the profitability, and the possible survival of that business. We see sometimes that there's some businesses, the failure to take advantage of opportunities is not necessarily because the business person don't have the vision. It's because, and it's not because also that somebody wouldn't fund the idea. Oftentimes it's because people are really not ready or willing to leverage their business up to take advantage of some of these opportunities. In wrapping up, We just have basically, and I think it was important for me to put this slide in. And I changed some of these things because if I didn't want to put them in that reflects the bank, because quite frankly, we've heard many times that people talk in financing decisions about the 4 C's for lending decisions, which is character, capital, capacity, conditions of the lending, and the collateral. The character basically I put in because it goes on both ends. It's about issues of governance and transparency. I spoke to that earlier in terms of, especially in the case where you are going to invite other people to be partner in your business, equity investors. There has to be, the governance issues have to be attended to properly, and so there has to be transparency. The capital, it's basically the risk appetite of the financiers, both the investors, that is the private investors, and also the lenders, because the lenders also have an interest in the business. But in terms of capital, it is important that investors note that you too are putting capital at risk. It's not just the bank. And sometimes when a bank says we're not willing to go there, sometimes it's best for you to just pull back yourself. Because oftentimes we can fall so in love with our ideas that we don't see the pitfalls just down the road. Capacity is really the ability not to pay the bank. That's what you would normally see in the banking parlor. But it's really the ability to make the business successful. And if the business is successful, all of the investors in the business, including the equity investors, the bondholders, the bankers, everybody would be happy. The conditions are really risk mitigating factors, again, to protect everybody. And the collateral is just assurances that banks take to make sure that, but we don't take all of your collateral, you get some things back. Just some list and some requirements for business. A business plan, basically, there are some people who, there are different views about business plans. I mean, most people will tell you, a bank asks you to do a business plan and you'll probably put it under the shelf, you never use it again. But again, I have a different view of it. A business plan is really a roadmap, and it's a critical communication tool. One of the things with business entrepreneurs is that a lot of the ideas are in their heads, sometimes not even their manager knows. You know, what you have to listen to it. It's not written anywhere. You have to listen to the conversations that you have, listen to when he's talking to other people to know exactly what the plan is. So let us see it as more of a communication tool. It sets out the purpose and strategic direction of the business. It is the connective thread between the business and its owners and managers. It communicates its owner's vision and the overriding objectives for the business, for being in this business at this time and in the future, because that's why we speak to what's happening in the future when we think of business. A list of requirements, and these are just some very generic stuff for starting a new business or new or existing. I have copies of audited financial statements and management accounts for the last 3 financial periods. That's for an existing business. And in the case of a startup, pro forma or projected financial statements and assumptions, so that, again, somebody who's reading it can understand your purpose for being in the business that you want to get into. In your business plan, justifying the reasons for the expansion or the startup of the business. If the business is owned by a company, copies of the articles and memorandum of association must be submitted, along with its certificate of incorporation. Also, a profile of the directors, owners, and statement of their personal financial affairs must be submitted. Again, the issue of transparency. If you tell your banker a lie, you're going to find out one day or the other. And you may not be a happy camper then. And the company resolution authorizing the borrowing. And finally, the certificate of good standing from the Inland Revenue Department and the NIS. These are some challenges sometimes that we find in dealing with companies. Banker statement reference where applicable, performer invoices and receipts to support credit disbursements, recent valuations, quantity surveyors report, copy of deed and title to whatever asset you're putting on.